From our studios in Scottsdale, Arizona, this is Retirement News Online. So the risks you face in retirement are very different from those during your working years. Things like market downturns, inflation, healthcare costs, and even living too long can derail an otherwise solid plan. Now, risk management is about protecting your lifestyle and peace of mind while still allowing your money to work for you. And these questions are something you should be talking about with your advisor if you have one. That's why I've got Grant Smith with me. He's with Lighthouse Financial in Rogers, Arkansas. What do I need to know about Rogers, Arkansas that I don't know?
Well, Northwest Arkansas in general used to be our best kept secret. Now it feels like everybody's finding out about it. So there's a lot of people moving there, a lot of money coming into the area, but gorgeous part of the country. Arkansas itself is a lot different than that northwest corner of the state. It's kind of its own little bubble, if you will, right? That's where the corporation's money and things like that are. So I hear people say when they visit there, a lot of times they don't even feel like they're in Arkansas. Right?
Interesting. Well, thanks for joining us today. I want to start talking about protection, really. So when you're working with a client, you know, whoever this may be, they're worried about market downturns, volatility. How do you protect them from that, which sometimes is just a result of timing, right? How do you protect them?
Yeah, it can be, right? I would say, you know, you always hear time in the market is better than trying to time the market, right? But obviously volatility can create concerns, especially in an inflated market like we are today. I would say ultimately some of the things that we do, we use a lot of structured notes for our clients for downside protection. But at the end of the day, right, our retired clients are still very equity driven. We use a lot of high dividend type portfolios for income, and having them understand that, right, that dividend's going to pay regardless of what the stock market does, right? Obviously a company can pull their dividend back, but for the most part, right, they're still getting their mailbox money, and we don't have to worry about market volatility as much. It takes a little bit more coaching on the front end, but we found that to be a very efficient way to take income in retirement and give you some of that protection.
I guess it's pretty obvious that, you know, some of the things that you need to do for somebody who's getting close to retirement, and I know you have a lot of younger clients too, you can't do it all with stocks, can you?
Yeah, not always, right? And again, I think we are definitely very equity driven, but a majority of our clients are still accumulating wealth. But as they get closer to retirement, right, the goal shifts not from accumulation, but more protection and income, right? I tell my clients all the time, hey, you know, you've won. We can take our chips off the table. We're going into protection mode now, right? We don't have to worry about, you know, catching that next big swing whenever the market goes up.
And we've just come off of, in one sense, a pretty inflationary period. So how do you protect against that going forward? Again, depending on who the client is, because we're losing, you know, purchasing power every year at some level.
Yeah, no doubt. So we got to make sure that the interest that is generated from those portfolios is outpacing inflation. I mean, that's the bottom line at the end of the day, right? And we use a lot of different strategies to do that. But like I said, a majority of the time it has been, you know, high dividend portfolios or, you know, structured notes that are giving you that downside protection, but paying, you know, 10, 12, 13% sometimes annually. And while inflation's been high, it's not, you know, 13% right now.
Right, that's good. And I know what you're talking about is diversification, right? So I think a lot of people believe they're diversified, you know, probably because they haven't worked with you yet, but they find themselves in a lot of mutual funds, a lot of ETFs, and when you get under the hood, they all have the same stocks in them, right? That's sort of naive diversification, I guess. How do you plan around that?
Yeah, no, diversification's definitely important, but one of the things that we really focus on a lot with our clients is not just asset allocation, but asset location, right? And the reason for that is because we believe that the biggest expense that clients have is the fees they pay the IRS and taxes.
Right.
So we can accumulate wealth strategically, right, across these different sectors and where they're allocating their dollars. It's going to have a much bigger impact than even 1 or 2% different market returns, right? If I can reduce their tax bill by 15, 20% just by allocating their assets strategically in different asset classes.
Yeah, and do you find that I think most people, they kind of think they're actually tax planning, but they're working with a CPA or like an accountant, and that's sort of a historical view?
Yeah.
You know, we're not looking forward? Is that pretty common?
I would say for sure, right? And I think ultimately what we try to do with our clients is making sure that all their financial professionals are on the same page, because we tend to find that oftentimes, not all, but accountants and CPAs can be reactive rather than proactive in tax planning, right? Clients take their CPAs, their tax return, or their information for the year, and they say, hey, I want to pay the least amount of taxes possible today, right? Well, it takes some planning in order to get there, but also, right, they're going to be reactionary, and if they're not planning for the future, they could be creating a tax snowball down the road, right, that they're not expecting. So.
And I think lastly here too, certainly you have clients where you've helped them accumulate and they've gotten to the point where you said it's time to take all the chips off the table, you're good, right? Well, there are some people who they're getting to the retirement age, they really aren't at that point yet. And we still need to protect them, but we still have to grow it at the same time. We have to keep our foot on the gas pedal going forward. And a lot of times for an advisor, that's probably the most difficult thing to do because you have to de-risk to protect and add risk to grow. So how do you find the happy median in there?
Yeah, I'd say we're very planning focused first and foremost, right? And so I'm never going to give a client the green light to retire if I'm not fully confident that they're never going to run out of money, right? But as we get closer to that time, right, if we need to be a little bit more risk averse, we'll do that, right? It's all up to the client and how much they're willing to take on ultimately, right? And so we're that behavioral investment counselor, making sure our clients don't make bad decisions, right? But at the end of the day, they're the owner of the team, right? They have to make the decision. I'll always tell you, I'll tell you exactly what I would do, right, if I was in your position.
Right.
But it's ultimately on you to pull the trigger, right? And so with that, I'd say, the plan comes first. So when we're looking at it and we're saying, hey, do you have the ability to retire right now? Yes or no? If not, these are the strategies that I would use in order to get you there in the near future.
And it's not set it and forget it, is it?
Never. Yeah, never.
He's Grant Smith with Lighthouse Financial in Rogers, Arkansas. This is Retirement News Online. Thanks for watching.